Hello everyone, welcome back. In this video, we are going to be talking about income shifting strategies and the related limitations. So whenever I think of income shifting strategies, the word that I keep in the back of my mind is move. So income shifting, we are moving things around. We're shifting things around. And what that income shifting is supposed to do is it is exploiting the differences in tax rates across taxpayers and jurisdictions. So whenever we want to move things around, how do we want to move things? From the income perspective, we want to move or shift income from high tax rate taxpayers or jurisdictions to low tax rates for taxpayers and jurisdictions. And the reason why is because if we have our income subject to a lower tax rate, lower tax paid, higher after-tax income. We always want to try to make the most that we can. From a deductions perspective, we would want to move or shift those from low tax rate taxpayers or jurisdictions to higher tax rate taxpayers and jurisdictions. So why would we want to do that? So deductions, if they're subject to higher tax rates, that results in a higher tax savings, and then subsequently a lower after-tax cost. So we want to pay for something as cheaply as we can. That's a way to think about it. So when I was explaining those, I was saying taxpayers, jurisdictions, taxpayers and jurisdictions. So how can transactions move around? They can move between family members. They can move between owners and their businesses. Or they can move across jurisdictions. So should I do something in state A or state B? I know we're not talking about international tax, but just another thing to think about from, like, if you were a corporation or a global corporation. Do I want to do business in country A or country B? For this strategy, we'll talk about the limits at the beginning before we get into the practice problems, because the income shifting strategy really has one big limitation that we need to be aware of, and that is the assignment of income doctrine. So this right here. And what that assignment of income doctrine means is the tax liability belongs to whoever earned the income. So what someone could potentially try to do, and I feel like this is probably a little more common with family members, parents and their kids. A parent earns income, but then they might try to shift it around to their children, because children, as an individual taxpayer, they would have lower tax rates as an individual versus someone who is married. However, if someone were to try to do that, that would violate the assignment of income doctrine because the parents, since they earned that income, they would ultimately be responsible for the tax liability on that income. So now over the next couple of slides, we'll work some practice problems. I believe the first problem is an example of shifting transactions across jurisdictions. And then the next one will be kind of a blend between like transactions between family members. All right, I take that back. It's mostly going to be family member related, but let's take a look. All right, so our first practice problem. Hyundai is considering opening a plant in 2 neighboring states. One state has a corporate tax rate of 10%. If operated in this state, the plant is expected to generate $1 million in pre-tax profit. The other state has a corporate tax rate of 2%. If operated in this state, the plant is expected to generate $930,000 of pre-tax profit. Which state should Hyundai choose? All right, so let's get ourselves organized with the information in our fact pattern. So the final question that we need to answer is which state, I'll highlight it instead, which state should Hyundai choose to open the plant? So let's get our options set up. We'll have, we'll say state 1 and state 2. State 1, or you know what? I'll put it in different colors so that way I can highlight and do my pens in the same color. Okay, let's try that again. So, state 1. State 2. All right, so what do we know about the first state? It has a corporate tax rate of 10%. And then in that state, the plant will generate $1 million in pre-tax profit. In state 2, the other state has a corporate tax rate of 2%. If operated in this state, the plant is expected to generate $930,000 of pre-tax profit. So with our income, we want to see which scenario is going to give us the highest after-tax income, because logically we would want to make the most money that we can possibly make. So let's break it down. In state 1, we noted 1 million. Let me make that look more like a 1. Sorry guys, my handwriting is terrible today. Okay. Oops. Okay. $1 million in pre-tax profit. The tax rate is 10%. So then if we multiply those two things together, our amount of tax to pay is $100,000. then if we take our pre-tax income and then subtract our tax liability, how do I want to organize this? There we go. We will have $900,000 in after-tax profit. Let's go to state 2, and I'm gonna move that over a little bit so we have some more space. Why? There we go. Couldn't get it to erase. Let's give us a little more space. Okay. So, state 2. The problem told us we had $930,000 in pre-tax income, and our tax rate was 2%. So if we multiply those two together, we would get an $18,600 tax liability. Then, if we subtract pre-tax income and tax liability, that will get us $911,400 in after-tax profit. So then if we look at our two after-tax profits, we would want the one that results in the higher after-tax profit. So then looking at those two numbers, that is this one here. And then to answer the question up above, which state should Hyundai choose? Oops. State 2. All right, let's take a look at our next example. So in this problem, Tawana owns and operates a sole proprietorship and has a 37% marginal tax rate. She provides her son, Jonathan, $8,000 a year for college expenses. Jonathan works as a pizza delivery person every fall and has a marginal tax rate of 15%. And this one, we're going to have 3 questions we need to answer. So first, how much pre-tax income does it currently take Tawana to generate the $8,000 after taxes given to Jonathan? If Jonathan worked for his mother's sole proprietorship, what salary would she have to pay him to generate $8,000 after taxes, ignoring Social Security, Medicare, or self-employment tax issues? And then, how much money would the strategy in Part B, the second bullet, save? All right, so let's get rolling on this problem. So this first bullet here, now I'm going to highlight them so that way I'll highlight them, and then whenever I write out the work, I'll match the pen in the same highlighter color. So this one, Let's do it in red, this first one here. All right, so the first one. How much pre-tax income does it currently take Tawana to generate the $8,000 after taxes given to Jonathan? So, if we think all the way back to chapter 1, actually going to switch my pen color here for a second. If we think all the way back to chapter 1, we had a handy dandy formula where we know that the after tax item equals the pre-tax item times 1 minus the tax rate. Sorry guys, it's gonna be scrunched up in the corner up here. 1 minus the tax rate. So then if we look at that first problem, and we just kind of plug in everything we know. So we're looking for the pre-tax income. I'll call it P, just so we can set up the formula algebraically. So we are looking for P for pre-tax income. We know that the after-tax income is $8,000. So $8,000 equals P times 1 minus, and then we need our tax rate. So in the problem, it mentions that Tawana has a 37% marginal tax rate. So that's what we'll use for our tax rate. So 0.37. So then to solve for P equals 8,000 divided by 1 minus 0.37. And that equals $12,698 for pre-tax income. All right, let's go to question 2. I will put this one in, let's do this one in green maybe. Okay. Cool, we're in green. All right. If Jonathan worked for his mother's sole proprietorship, what salary would she have to pay him to generate $8,000 after taxes? So we still have that $8,000 after taxes. We need to know what the salary is, so we'll use that P for our pre-tax income again. And then 1 minus, and then let's look for the tax rate. So in the problem, it mentions in the second sentence right here, or let me actually count the sentences, 3, the third sentence, Jonathan has a marginal tax rate of 15%. So then this will be 1 minus 0.15. Pre-tax income equals $8,000 divided by 1 minus 0.15. And that equals $9,412 of pre-tax income. So pretty significant difference in the pre-tax income, which is good because that leads us to our final question. No, hold on guys. Sorry, my highlighter's being weird. Okay, let's try this now. There we go. Okay. So now part C. How much money would the strategy in part B save? So if we take our pre-tax incomes, so it originally took $12,698, but now it only takes, or now it would only take $9,412 to generate that $8,000 after taxes. So if Tawana employs her son, she will save, let me make sure I actually entered the numbers right in my calculator. Hold on, guys. Yep, I did. 3,000. Keep losing my pen. There we go. $3,286 in savings. All right, that is everything from the income shifting strategy. We are almost to the end. The next set of videos is going to be all about the conversion strategy. I'll see you guys soon.